Welcome back to the advisory series where I'm going to introduce to you Tyler Heidebrecht, who is a CPA for Fleming Tax. He's going to discuss how tax planning can be vital in your process, both personally and in your business when it comes to the exit planning process, and how you can lean on the CPA during that. You're going to like this one. Enjoy.
Selling a business can be one of the most exciting and stressful events of your life. How do you know what your business is worth and whether that offer that you are getting is a home run or will have you out at first? Now, most of the time, buyers will buy your business on EBITDA or a multiple of that number. What is EBITDA? It's earnings before interest, tax, depreciation, and amortization. Basically, that would be the cash flow for a new buyer. That would be step one in the buyer's equation, and they would likely offer you a multiplier of that number. So let's say that your EBITDA is $200,000. They offer you 2.5 EBITDA. So they offer you $500,000 to buy your company. They explain that it would take around 2.5 years for them to recapture their investment, and that is their normal procedure. So you agree on the $500,000 number. Sounds good to you? Sounds good to them. Generally, after they review your company, they are going to find some alarming discoveries that are going to drastically reduce what they are willing to offer you. Remember, they buy businesses for a living. You do not sell businesses for a living. They are shrewd. You may get screwed. Now, instead of the $500,000 they were initially offering, they are now dropping that to $400,000. Well, $400,000 is $400,000, and you are tired of working, so okay. Now that you have sold your business for $400,000, you wonder if that was a good deal. The buyer knows but doesn't tell you that you have not accounted for the most valuable asset that you have, your repeat business client list and the value of your company's name in the community. You gave those assets away for free. This is the struggle with selling your business based on an EBITDA model. It doesn't account for maybe your greatest assets, your intangible assets. Now that you have sold, you have money in your bank. However, not all of that money is yours anymore. When you sold your business, you created a taxable event, and the taxes on that can vary wildly based on whether it was an asset sale or a stock sale. If you sell your stock, you get to recognize capital gain rates on that sale, which can be 15 to 20% less than ordinary income tax rates. Capital gain rates would be about 15 to 20%. So at best, you would be recognizing $400,000 times 15%, or $60,000. However, the buying company doesn't want to buy your stock. They want to buy your assets, so they could depreciate those purchase prices. Good for them and bad for you. Now that $400,000 is no longer eligible for lower capital gain rates. Now, they is subject to ordinary tax rates at say 32%, and you no longer get the state tax exclusion on top of that. So that $400,000 gets taxed at 37%, which is $148,000 in tax. Now the $400,000 you got from selling the company is only worth $252,000 in the bank. So selling your business the wrong way cost you an extra $88,000 in tax to put the $100,000 that you got from not selling your company well. So you've lost nearly $200,000 from your account. This is one of the reasons to consider having your friends at Overflow Wealth Advisory to help maximize your sales price and Fleming Tax to help you maximize your tax savings. We can help you sell smart and for the most economic and tax-wise way possible. We want to help you keep more money in your pocket.